Welcome to the Multifamily 0 to 1 online meetup, where we discuss the best strategies to get started in apartment syndication.
So thanks everybody for joining us. Today we have Nathalie with us, and she will introduce herself in a minute.
Before we get started, I just want to remind everyone that this is an educational presentation and we're not making any investment recommendation. You should always consult with your CPA and attorney for financial and legal advice.
Let me introduce myself. So my name is Marcelo Cazini. So my background is in IT and software development. I'm also a local CCIM member here in Houston with all the CCIM training. I'm a multifamily investor, and I operate my own commercial real estate. And I also done some single family fix and flips before getting into multifamily. Martin, Claudia.
Hi everybody, this is Claudia Rubio. I think we've already met, but just in case, I'm a commercial real estate investor based out of Houston. I was born in Colombia in South America, and I have an architecture degree, and my background in asset management comes from back in Colombia, managing our own assets.
I'm an IT security consultant. I've been doing that for over 25 years. And we have been both, since we're together, we've been related to real estate some way or another. We joined this multifamily environment probably around 2 years ago. Nathalie was one of the first people we met. And up to date, we have invested passively or actively in around 800 units, and we have successfully led our first syndication here in Houston. We closed last year in December.
Congratulations.
Thank you.
Thank you.
Yeah. Nathalie, do you want to introduce yourself?
Sure. Good evening, everybody. Thank you, Marcelo, Martin, Claudia, for having me on. It's great to see and interact with people in this strange environment we're in these days. My background is in engineering. I'm a chemical engineer with an MBA from University of Texas. I guess it's all written there, so I don't even need to think about it. But was in oil and gas out of undergrad. Worked for ExxonMobil at the Baytown refinery here in Houston, and first, actually before that, on a trading floor. And in 2007, started a physical commodity trading company with one of the traders from ExxonMobil, and grew that business from the ground up. So it was just two of us for the first couple years, and grew it organically and also through acquisitions. And in my last few years at that company, because I no longer work there now, I was exclusively pretty much involved in mergers and acquisitions, looking at assets and companies, $60, $70 million acquisitions from valuation through closing. So not multifamily, but there's a lot of similar skill sets that go into that. And since 2009, I've had a portfolio of single family rental properties, and I've been a self-managing landlord of single family rentals for over a decade. For most of that decade, it was 30 single family rentals. I'm down to about 10 right now. In terms of apartments that I'm still invested in, 24 different apartment projects. It's been about 33 in the last 5 years that I've been involved with, and roughly 1/3 of that I'm a sponsor, GP, if you will, on the syndication, and 2/3 of those I'm a passive investor. So I think if I understand the presentation tonight, it's going to be mostly for passive investors. So I'll focus on the 2/3, which is most of what I do actually. So.
Sure. Yes. So Nathalie, thank you. And again, thanks again for being here. And so you just told us that you started real estate with single family. And how did you get into multifamily, and what attracted you from multifamily?
Well, I wish I knew about multifamily back in 2009. I really, really did. But I think, like most people, the assumption was that it was completely out of reach. Uh, and, um, and what got me started was being that single family landlord, you know, was buy and hold view, so conservative. I just got tired of it. And a couple years into it, started looking into different avenues. And knew that because it was going to involve more capital, that I wasn't going to do what I did on single family, which is go it alone and make those mistakes on my dime. That I was going to do it with help and guidance. So it actually took me a couple years of going to different, I don't want to say gurus, but different program events across the country before I found, I guess, my group. I don't know if we're mentioning specific groups. I don't think it really matters, but before I found a program that I felt comfortable with, and that's what got me started. And the attraction was pretty much immediate. I think with a lot of people, there's this aha moment where the big one for me was return on time, ROT. I mention it at my meetups and things like that, and it really is a true measurement. Not every passive investor is at the same place. Some folks are still looking to build up their capital. Others have already reached that point, and then it's about keeping that money growing and moving. And really, you don't care about that principal amount anymore. It's about the return on that. And thankfully, I'm a little more in that second bucket. But that return on time was huge. Coming from self-managing single family on my nights and weekends to the possibility of a professionally managed asset, and if investing passively, being able to invest with folks that I felt I could trust and had the knowledge and experience to successfully manage an investment, makes your job, I don't want to say easy, but it narrows it down to knowing who you're investing with, and also obviously knowing about apartment investing before you do get in. So return on time was the attraction, and the fact that it's a business. It isn't like single family where you're subject to comps the way MLS is and things like that, and in the ways that it's a valuation process where you're looking at the net operating income. And what I had to learn about that was different from my oil and gas, we look at ratios, and for some of the storage terminals and things like that. For apartments, it was cap rates, so there was a learning curve there, but acquiring a business was something I felt very comfortable with. And then there's scalability to apartments, where it isn't you just do one or two deals and you're done, unless you're investing individually. There's a lot of different ways to get involved with apartments. I've done, I think, most, if not all of them, but investing individually, buying your own asset, sponsoring, syndicating, co-syndicating, investing passively, tenant in common, also a structure that may work for some folks. So different avenues, different exit strategies. Some are shorter holds. I personally prefer longer holds because I have a longer time horizon, but there is something, I think, out there for everyone. So return on time, it's a business, and it's scalable.
Okay,
Yes.
that's good. So when you found multifamily and you wanted to get that education that you mentioned, that learning curve has the business side, which you already had that from your professional experience. The new things you had to learn, did you get all of that from the Summer group, from the group that you joined, or did you had any other educational sources like books or podcasts or anything that you used other than the group?
I think most of my learning came through people that I interacted with, whether it was through the Sunrock group or other groups. I don't learn so much by reading books as much as, gleaning from other people's experiences and things like that. I think a helpful list of names that I wish I had when I was starting out, because it's hard to decipher who's, you know, I don't want to say the real deal, but is worth listening to and who's not. So rather than do books, you know, maybe just a list of names could be helpful. But Brad Sumrock is the group that I ultimately joined. I'm in Rod Cleef's multifamily boardroom or mastermind. So Rod Cleef is another. Michael Blanc, Joe Fairless are others that have, Michael Blanc has an analyzer that several people I know use. Let's see. Neil Bawa has a lot of free data-driven content, specifically when it comes to, for those that love the numbers and the data, drilling down to not just a zip code, but that, you know, the intersection of the streets where a property is, and what the population growth. I mean, all the different numbers that you would be looking at for an asset. So he's got very good content. In terms of an analyzer, David Tupin has an analyzer that I think he's about to, or has already made it web-based now. So that's another resource.
Interesting.
Nice.
Yeah.
So in that initial phase of that avenue of collecting the information, meeting the right people and all of that, at some point you felt ready to make your first investment, right? So
yeah.
What were you looking for on the deal or the syndicators for you to be comfortable, like a specific market, specific returns, specific threats on the people that you were going to invest with?
Yeah, sure. So I would say there was about probably a almost 2-year period of just kicking tires, doing that initial, like looking at things before joining any kind of group. But within 1 month of joining a group, I was invested in 2 deals. So that happened very quickly. The timeline of joining and being passively invested, because I did start that way. And yeah, within 1 month, I was invested in my first passive investment. And I'm sure a lot of people have already said this. It starts with who you're investing with, was with Michael Becker. And the rationale behind investing with him at the time is that out of all the people that I had met at that point in 2015, so this was 5 years ago, he was the most experienced person I could find. So I was like, okay, I found somebody who has a track record, who has experience, who's gone full cycle on deals. And he comes from Wells Fargo, so he knows the confidence was there. So I hadn't thought about syndicating yet, but I wanted access to him should I have questions. So there was kind of a twofold. I'm investing my money for a return on that, but I'm also investing it so I have access and further my learning. With that approach, invested in a 352 unit Class B apartment complex in Denton, which is north of DFW. Still north of Grapevine, the property went full cycle, so it sold at the beginning of this year and closed. It did have 12-year Fannie Mae debt on it, so they had to. The sales process was drawn out because of yield maintenance going up while it was under contract, and challenges that a lot of agency financed deals have right now on the sales side. And that deal from my perspective was successful. We've essentially doubled our money in 4 years. So I think I put 150,000 in it, and over the 4 years got my money back and that amount back. So really, I do lending just like Just Breed and typically get an 11% return. So this was twice as good as that, so I'll take it, and with some tax advantages.
Yeah, for sure.
Yeah, so no regrets on that first deal, but I didn't know what I didn't know when it came to underwriting, so I can't say that I thoroughly scraped the deal, and it was one of those, some of these deals go pretty fast, so you don't have the time to interact as much as you'd like to up front with the sponsor and pepper them with questions, because by the time you do, there's nothing to invest in anymore. Not all deals are like that, but that was another thing.
Yeah.
And for someone trying to get started right now, Nathalie, as a passive investor, what would you say would be your best advice for them, especially given the environment that we are right now, and if they're just starting or they're trying to get maybe their second or third ones? What would be your best advice?
Don't let, if you have money in your pocket, don't let it burn a hole or rush to deploy it. I would be cautious, particularly in today's environment. The part that I think is important is to really reach out and relationships come first. So reach out to all those sponsors, take the time to get to know them, and that's more than just the one or two interactions or three that you might want to have for SEC box checking. What you actually want to do is all the questions that you'd ask when there is a deal, ask them before there's a deal. That would be my advice. So ask them about their deal structure, about their track record. Ask all those things up front so that when they do have a deal, you already know all of that, and you already pretty much know whether or not you're going to be ready to move forward with them. So it's relationships, typically, we're all human, get built in person, and that's right now we're all having to do it through a screen, which I don't like. But to the extent you can by any means, whether it's Zoom or phone, or take the time to build those relationships, because that's the best return overall on your time. The education piece is important as well. I don't want to completely disregard that. Learning and knowing how to underwrite really comes with time and experience, because you I'm saying it again, you don't know what you don't know, but there are a lot of variables to consider when it comes to a deal. And as you interact with different sponsors, you're going to perfect a list of questions, and your questions will just get better, sharper as you go along.
Yeah, for sure. So you mentioned that your first deal you didn't analyze or underwrite as much. Do you now have a way of analyzing it from a passive perspective? Like, I know perhaps not right now, but I know a few months before COVID, it would be very typical for somebody to be getting like 2 or 3 deals at a time being presented to them to invest. Do you have any techniques that you take in terms of quickly looking into a deal to make a decision if you want to invest? And what are your
first and foremost, it's who's presenting the deal, and who's doing what in the deal. I tend to funnel it through pretty quickly. I don't even it's not really even a mapped out process, probably as much as it should or could be. But the underwriting has to be conservative, and it's not all variables across the board, but there are a few in there. If there's key variables that are just too aggressive, I won't even look at it. To get my interest, though, before COVID, it had to be high cash flow. I didn't even care so much about the overall return, but that cash flow component was really the key. And then because a downturn was essentially expected, I was looking for about a 1% delta between that normalized entry or purchase cap rate and the reversion or exit cap rate. People call it different things, but that difference between the going in valuation and the exit, pretty much to underwrite a downturn, I was looking for 1% or more, and a lot of deals didn't really meet that. And then there's some folks that you look at ratios, whether it's income expenses or a ratio of of income over the purchase price. But I don't think any of those quick, numbers help that much, because every deal is a little different and has its own nuances. A lot of times the money in a deal is in the details, and it's also about understanding the value add opportunity. So if the value add opportunity includes really pushing the envelope, converting every single unit, and all the low hanging fruit is pretty much off the table. That doesn't sound, that wouldn't be something that I'd be as excited about. And then obviously looking at where a property is located, making sure it's in a market that has supportive job and population growth numbers. So I don't think that gives you a quick analysis, but it's some guidelines of what I'd look for. And if I really have questions, then I'm asking for T12 and rent roll and pretty much doing the full underwriting. And you'd be surprised, there's sponsors that don't share that. And I've passed on deals and I was like, okay, no T12, no rent roll, no thank you, because I didn't get answers that I didn't get comfortable with the deal.
Yeah, but so if I heard you correctly, before you even look too much into a deal, you're gonna look into, is a sponsor somebody who you know and trust, and then the 1% cap rate reversion and a high cash on cash.
Yeah.
And if you would meet those three criteria, then you would look forward on the deal.
Yeah. Yeah.
All right, fair enough. And would there be anything that you would look in terms of how much they are claiming that they're increasing revenue or they're decreasing expenses? Any red flags on revenue or expenses?
Yeah, I mean, I understand reducing expenses a little bit if you're spending capex, but keeping that within reason. So if it looks too aggressive, then I'll ask for the breakdown, because not everybody has it in their deck of the expenses to see where they're getting those savings, and some are justified and some are really squeezing it too much. If those are on the property taxes or insurance, for me those are red flags, because most folks are underwriting those two in particular too aggressively, and seen a couple deals get squeezed on those expenses in particular. Payroll, some management companies are known for being low on payroll, but next thing you know, 3 months, 4 months down the line, you're switching management companies on that property because it's not able to operate successfully. I don't like the other income boost. If it's too aggressive, if there's amenities that are already there that are not being charged for, but that all the other properties in the area are charging for, then yes, by all means. But if you're putting in, 50% of the parking lot is carports, and you're assuming, 80 or 90% of that's going to be paying rent for the carports, you have to look at what's reasonable. Some of it's I don't want to say gut, because you have to be aware that people play with those numbers. They do.
And Natalie, I was going to stop you just for a second. That a lot of times I've seen stuff written under other expenses, other income, other this. And every time you ask for that breakdown of, well, what's really in that other? Well, no, that's already there. They're already collecting this from a little bit of that and a little bit. And that's what scares me most in all these deals, is when they can't come to you and explain exactly what that other income is, or those other expenses that are just vanishing off your plate. And, oh yeah, you'll just recover those. These are just the owner-specific expenses that you'll be able to recapture. Well, what are they? Oh, well, yeah, that's the security, contract that they have in place that you can't get out of. Well, then no, I'm not going to recapture those. Those are still going to be there because I can't get out of it. It's just those little things that may end up looking at, you know, $20,000 a year easily, and you just, they claim you can recapture, but you won't be able to.
No, and that's why having those conversations early with sponsors, even before they have a deal, you start getting a sense. I mean, not everybody, I don't claim to be a perfect judge of character and that I'm able to say, okay, this person's trustworthy over another, but to the extent, you know, I try to make an assessment. And then you look for transparency. You look for whether or not when you're asking those questions, you're getting the answers that are satisfactory to you. If there is a cable contract, for example, we had a deal with a cable contract. Well, it still had a year on it, but we were going to prepay it, included that amount in the CapEx, and then we were able to underwrite the deal without that expense and also get more loan proceeds with that underwriter, and that was acceptable to the lender. But we had to explain that to investors. A property has carports. Everybody else in the area doesn't have them, but this property is not charging for them. Well, that is a low-hanging fruit. That's an opportunity. So it's digging into numbers and understanding, you know, what is behind them, and it's not just pulled from the sky or wishful thinking.
Yeah, and I think a lot of people assume that other income is going to be there always, and as you said, I think it's a case-by-case basis. And
well, COVID has shown that, right? I mean, late fees have been slashed, and if you have a property that you know, the C-class properties, the residents live paycheck to paycheck, and there is a good portion of other income related to late fees, and if you're not able to charge those, it affects your financials.
Right. Yeah.
Yeah.
Nathalie, along those lines, I was also wondering how you, for example, or other people that have more experience than I do, how do you handle that type of question? What is appropriate or what is not appropriate to ask a key sponsor? Being a limited partner, is it appropriate to ask as much detail as we possibly can to understand the data and the numbers that are going to go into it? Or are there certain things that are kind of like, this is something just for the deal sponsors to know, and you as a passive investor don't have the visibility to that? Or should it be more of a, here's everything that you need to know, including those little expenses, and take it from there?
So here's what I would say. I'm going to assume that you haven't invested in the deal, and these are all questions before you're making an investment decision, correct? Right. Okay. So you're looking to invest, yes, call it limited partner, however, but you're a member of the LLC that owns the property. So by virtue of that fact, you are a realist, you're an owner, or you're a partner in the LLC, but essentially you're an owner in that entity. And for the privilege of you putting your funds in there, they should answer any and all questions you have. Whether or not those answers will be complete and satisfactory to you is something else. But there is no restrictions on the questions you can ask. None. You're about to be an owner. It's your money. You can ask any. There's no questions that are off the table in my book. That being said, some of the larger, quote unquote, more sophisticated shops will claim, oh, well, this is proprietary information. I have an example. I have, as a syndicator, I have to produce a schedule of real estate owned, which includes details of the debt and things like that. And this larger shop felt like it was proprietary information to disclose who the lender was and the terms of the loan on the deal. And I was just like, oh, you are kidding me. This is an opportunity zone fund. It's a development. It's not a, it's a construction deal. So it's not the agency debt the way we have it on existing deal. But the fact that they had that approach where they just deemed it, nope, this is confidential. I was like, so had I known they were going to be that way, I probably would have thought twice, but I had folks that I trusted recommend, and I knew had a need to do an opportunity zone investment. So I have money invested that way, but I will not invest with them again.
Yeah, we get
Fair
this
enough.
question.
Thank you.
We get this question in several of our meetings already in terms of being concerned about what is the right question to ask a sponsor, and we always go the same way, that there should not be a concern about asking questions to the sponsor, because if you're trusting them with your money, then you need to be making the right decision. And if they're squished about giving you the information, maybe there's going to be other sponsors.
They're earning your trust, and what you're looking for in their answers is transparency, right? You're trusting them with your money, and they need to be answering your questions.
And one more question, if I may. I know that with COVID, it's been a little difficult to meet in person and do a little bit more networking. But what would be your recommendation for me to be able to get into more syndicators list, so that I can receive deals whenever they have one available for me to try to invest? I've only invested in one deal, and I would like to continue investing this year in a few more if the opportunity is right, but I'm not getting as many. Do you have any recommendations?
Yeah, well, the reality is that the deal flow after March pretty much dried up completely. So it might be normal that you're not getting as many, but in terms of free ways of growing your network of sponsors, there are a large number of different Facebook groups out there to join and be a part of. Some larger than others, but to the extent you have the time and you are on Facebook, getting into those groups and basically seeking out sponsors. And then once you're finding those who are sponsors, exchanging the contact information and having repeat interactions with them to get to know them. So I encourage passive investors to be proactive when it comes to reaching out to sponsors, if what you're looking to grow is deal flow and investment opportunities. That's your job.
Thank you.
Yeah, and I think most sponsors would be very happy to get on the phone with you, because they, by law, they have to have established pre-existing relationship with you. So it's their best interest to have those phone calls and explain their business model to you. So asking for a recommendation as you meet somebody, like for example, now you met Nathalie perhaps for the first time, then contacting Nathalie, having that conversation, and then from there maybe you get a suggestion of somebody else, and then you just go from one person, because you want to, there's so many out there that you want to also go for people who you can know, like, and trust, and being recommended to somebody. I think it's a way to see who are the people that, like, for example, in this group here, they invest, and so then you get the recommendation of those people, then you can go talk to them, and then you go and start increasing the circle there. But I would definitely make sure that you're doing the due diligence on the person as much as you do on the deal.
Yeah.
Right. I mean, it honestly has been a little difficult for me to figure out who is better than the other person, because this network has been very strong. I find that pretty much everybody that I speak with is very polite, very respectful, very knowledgeable. So I don't have any negatives at all. So that's a good thing. But it would probably make it easier for me to be able to meet more people in person, and I'm pretty sure for everyone.
Yeah.
So that you can kind of get a sense of that.
Tangible things you can ask for are maybe a summary of their track record, what deals they've done, have any of them gone full cycle, what were the numbers, if they'll share any of the deals that they currently have under management, and a copy of the monthly, or in this case weekly reports that are going out, and some sponsors are willing to share that, others are not. I've gotten some passive investors that were very surprised that I had no problem emailing them that information, and so ask for as much as you can get your hands on. It's all learning too. That's the other part.
Correct.
And I think the offering memorandums that they've presented to their previous investors or deals that they've done full cycle, so that way you can see, okay, well, what were they projecting in their offering memorandum? And then when they went full cycle, what was the actual end result? That's really going to show if they are one of those overly conservative people going in, or are they one of those that are really just trying to squeeze the juice from day one and they barely scrape by at the end.
Yeah,
That's
yeah,
a
no,
good way to check
that
it.
I'm so glad you mentioned that. That is another thing that I've sent on most of I've sent to other passive is prior deal decks, so they get a sense of, okay, I don't have anything on the table right now, but here's something I've syndicated and what it looked like, and then dovetailing that into that reporting, whether or not they're stewarding their monthly financial performance to the budget that they established with the management company, or are they stewarding to what they presented to the investors and promised them at the time the investment was made? And those are two different numbers. And there's a lot of sponsors that'll go, oh, that pro forma or that deal deck, that was out the window the minute we closed. It doesn't matter anymore. You know, this is the new reality. It doesn't, as an investor, even if the reality changed, you still want to know why, and that's what you should be comparing your results to. So I typically have the pro forma right there that was in our deck right next to what our monthly result was, and then I take it down to the net, not just the NOI, but the free cash flow. Essentially, every month, investors know exactly essentially how much accumulated distributable income is sitting in the deal for them that will eventually be distributed. It is their retained retained earnings. It is their money that is due back to them, and they know exactly what it looks like from one month to the next.
Great. And going back, if anybody has anyone has more questions, I would like to ask you. You have a lot of experience now, and I guess you've been through a lot of stories and maybe things that you will have done different now, or mistakes you've learned from, horror stories for the passive investors you would like to share with us.
Yeah, I think, when you're talking to sponsors, what you're trying to make sure there is alignment. Is this a sponsor that's under pressure to do deals in order to pay their mortgage? How much skin in the game? That's another term that gets thrown around a lot, but how much fresh capital beyond any fees or other compensation they're getting are they putting in the deal? The deals I've been involved with, it's 10% of the capital raise is fresh capital from the sponsors. So we're just raising the other 90%. So there is a commitment that we're, hand in hand, drinking our own Kool-Aid, however you want to put it. But that skin in the game, one of the deals I wish I wouldn't have been a part of that's struggling, that's selling right now. It was one of the earlier deals I invested in, but I didn't appreciate how much that skin in the game factor plays into whether or not how the sponsor is going to behave. I mean, everybody's human, but if they don't have a lot on the line, how much are they really going to care? How are they going to prioritize that deal over another in terms of their time, focus, etc. So that alignment is key, and alignment also ties into acquisition fees or any kind of upfront fees. So basically, sponsors getting paid upfront before anything happens. I think that can really handicap a deal. I think a lot of deals that have happened in the last year with high upfront fees may have a harder time, recovering from that. And then Let's see. Trying to think about. I mean, horror stories. I mean, I've got a lot of things that have happened at properties, from flooding to buildings burning down to a car running into a building, drug dealing.
Wow.
Yeah, I mean, it's not all pretty because the type of properties that we're investing in, it is a lower demographic, and you don't want you the last thing you want is these kind of things happening. People killing each other, passion murder, like basically a girlfriend shooting her boyfriend. Yeah.
Wow.
So there's a lot of interesting.
What about markets you regret investing in?
Oklahoma's tricky. I'll leave it at that. It's not that there aren't good deals in markets that that can be more challenging, but I think that's where my focus on cash flow over the overall return is some level of protection against that. But if you're used to Dallas growth, because the growth has been phenomenal in a market like Dallas, that is not translatable to slower flat markets like Oklahoma and Arkansas. The other deal that pretty much was almost a total loss of capital, which most people go, what, that happens, but it does, has less to do with the market and the location and more to do with the sponsors, their trustworthiness, and essentially one of them committing fraud against the entity. So that was less of a market and location and more of a factor of the sponsorship team. Markets matter, in my opinion. They matter, but they're secondary to the sponsorship team.
So Natalie, on those horror stories, do you have anyone where was something that as a passive investor you had something that you could have prevented, like maybe the interaction with the sponsors or something that?
So on the I'll bring back the horror story of almost a total loss of capital, because that always gets everybody's attention. But on that one, the guy that committed fraud pretty much essentially was fooling everybody at the time. He fooled the lenders. He fooled it, and I didn't know. I guess what I could have done was know every single sponsor, because what happens is a lot of times there are multiple sponsors and you might have a relationship with just one of them. If the person that you know isn't the one that's in charge or driving key components of the deal, then maybe pause and wait for the next deal and get to know those new people that are involved first. Because it is all about people. So that is something legitimately I could have done. I didn't believe that there was a concern at the time, so I'll admit to being naive. But fraud was committed. Legal action ensued. This gentleman was kicked out of the GP and ultimately committed suicide. But that was
That is a true horror story. Oh my God.
Yes. And there's still some drip, a couple $1,000s that I may be getting back post all of this legal drawn out mess.
Wow. And Jaspreet, I think you have posted a question on the chat here. I was thinking maybe it might be easier for you to ask the question. You had some question about the depreciation recapture. Do you want to just ask
that question was around as a passive investor, when you mentioned your 2x in 4 years equity multiple on your first deal, and let's say you have all these K9s with the accelerated depreciation, with the cost
K1,
segregation stuff.
K1.
Oh, sorry.
K1.
Yes. I don't know why I keep saying K9s. Okay.
Oh, it's those K9 units, you know.
I
those
know. I know.
dogs.
I'm looking at a street where all those K9 units have driven past. So it must be that.
Yeah.
But yes, the K1s, right, have those passive losses that you've accrued up for a couple of years. And so let's say you're able to take those passive losses against this final sale, but I'm sure there's still a good chunk of money that's come in that can't be accounted for by those K1 losses. And let's say you make other money in active investments as a private lender, like you're doing and I are doing, or flipping and all the other investments to put together. Like, how are you able to offset those taxes? Or are you just straight up saying, all right, well, that is what it is, here you go?
I'm old school. I guess it could be a spreadsheet, but there's a lot of noise, especially as a passive investor. You don't know what your cost segregation is going to come in at on your passive investments. So a lot of it is ballparking, but I've gotten it down. You know, I don't want to say, oh, I'm, you know, amazing, but the last 2 years, my income's been, you know, from a tax perspective, below 100,000 when I'm making, you know, well over $1 million. So the calculation comes into play when you have, because every deal that sells, you definitely have depreciation recapture. So you're not just getting that money back, you're also essentially getting hit with the depreciation that was taken over the holding period of your investment, which is another reason why I like longer term holds, because you're pushing out that depreciation recapture to a date further down the line, and deferring taxes that you will eventually pay out further, and able to have the money grow in the meantime. So it's a balancing act of reinvesting the money and you know, as properties sell. So when the music stops and you decide to stop investing in apartments and having that that tax deferral vehicle, then you either find another or you pay a very large tax bill. I don't know if that answers your question.
It does, but I thought that for that deferring vehicle to kick in, you would have to do a 1031 exchange or a DST or any of those things as part of the whole entity.
Well, you can do those, but if you invest in another apartment deal, you're getting essentially the same benefit, because I'll invest another, you know, couple $100,000 and get 60 to, in some cases, 80% of that back as a loss the year I invest it.
Got it. So it's not deal specific. It's at the end of the year bottom line number that matters.
So
the
year you close, so the year you, not necessarily the year you invest, because sometimes you can invest in a deal, but it doesn't close until the following year. But the year it closes is the year for an apartment deal you get if you're able to, if you qualify for taking that being able to offset with that depreciation, you're able to take that loss against your other gains.
That's assuming that they are doing a cost segregation.
And I think I haven't invested in a deal that doesn't do a cost segregation, and I feel like most people are doing them. But, you know, and I'm also a real estate professional, so and it sounds like you are as well.
I'm trying to be. I'm trying to get to that point because I sold off all my rentals last year, and only now did I realize, wait, I need at least one to be able to claim that status in my portfolio as an active member. So I just bought one this year. But otherwise, I was like, oh, well, yeah, private lending and all these syndications, I should be able to qualify with no W-2. But apparently, you need one rental. So I've got that put into place now, and that's what I'm going to leverage to try to take all those passive losses against my active income and hopefully be like you one day where, you know, the 1 million gain is still going to result in $100,000 income.
Yeah, it's not tax elimination, it's tax deferral.
Yep.
You can go for opportunity zones. That tends to help you out on that.
And that was the one deal I was mentioning. that gives you a little bit of a, but not all of those deals are that attractive.
True enough.
Yeah. And what happened is it was the buzzword. Everybody and anybody wanted to get into those. And so there was so much capital and there was a lot less deals. Funds, had the money, but were stretching to find deals that actually provided a decent return.
Now, there is also, if you die, you can pass it to your heirs with a bump up, but you're still dead.
Yeah.
Yeah,
No,
that's where the DST comes in, right?
Yeah, I'm 37. I have a 1.5-year-old and a 4-year-old. I have no plans of.
Yeah, I'm 37 and a 4-year-old as well.
Yeah, and I think that I should have led with that. Who cares that I have a chemical engineering degree or an MBA? I'm a mom of 2 young children. I started multifamily 5 years ago before I had kids, and the biggest thing that apartments has done for me is the extraordinary amount of time that I'm able to be. Especially these days, but that I have the flexibility of being very present and pretty much with our kids every day. When they were going to school, I was dropping them off and picking them up. Now, I interact with our kids most of the day. It's not something I could have done when I was at the trading company. Not at all.
Well, for sure.
Nathalie,
Yep, that's what got me too.
just another question that just came to my mind. How do you have a system to track your deals? Because you have a lot of passive deals. How do you track all of that information, and how detailed are you on those?
Well, there's a Fannie and a Freddie sheet that's actually fairly detailed in terms of the loan details, the NOI, your share of that equity. That's where you immediately see the haircut that you're taking at the beginning and the valuation of the property. So I basically have a modified version, a slightly enhanced version of the Fannie SREO, Schedule of Real Estate Owned spreadsheet. And I have to update that anyway on a regular basis for the deals I'm in, when whether it's a new deal or a refi. So I might as well, use the same thing.
No, updated.
So I basically have that spreadsheet, which I need to have anyway for the agencies, and then I have a couple extra things on there. It's not that fancy. And then as a passive investor, unless a deal's completely going crazy, there's your choices are to change the management team or to just ride it out. I've really only had one deal where I felt like there was just too much silence and was a little bit of the troublemaker in terms of getting passive investors organized. So figuring out who's in the deal, getting on calls or emails, and basically forcing action on the part of the sponsor. So it's not like we kicked them out, but we essentially made enough noise to say, hey, there's some basic things you need to be paying attention to, and we don't want you to just tell us, oh, look, it's been 2 years, look, we'll just throw in a playground, you should be happy now. No. We still want regular reporting if we're very far behind where we were supposed to be, and an explanation as to why that's the case.
Mm-hmm.
Now we're in. I'm in a deal that's in that situation right now. We're trying to force transparencies on certain things from the sponsor team, and it's just painful.
That transparency thing is big. I think, people will say, oh yeah, I'm a sponsor, I'm trustworthy, whatever, but it comes down to how they handle the bad news. When things go wrong, I'll invest with someone again if they handle the bad news, basically communicate through it. Tell me what it is. We're all adults, we're big people, we understand that there's risks with these investments. And if they're willing to, communicate through it, explain what the different challenges are, and keep the investors updated through it, I think that makes them a better sponsor, even if you know, there's challenges, and maybe somebody in the passive on the LP side might have an idea about a way forward, but oftentimes it has more to do with, you know, silence is worse than
For
you know,
sure.
is the worst thing. And human nature, I think when people don't have good news to share, they just want to, like, okay, we're just gonna hide behind, you know, silence. Investors are going to imagine the worst, and that's that. Then imagination will yeah.
Oh yeah.
And with COVID-19 now, Nathalie, are you still, from a passive perspective, are you taking a break from looking at deals to invest? Are you still considering and looking at deals if they are presented to you? What are your thoughts on how to ride this storm right now?
Yeah. So COVID, it's just a lot of uncertainty. I think just like a lot of other people, I hit a pause button. I'm not saying that I'm paused right now, but some markets like Houston probably need a price correction, and then there's the factor that there's so much money on the sidelines, whether it's money from people pulling out of the stock market, money that, you know, there's a lot of pent up buying demand when it comes to apartments, that there's deals that are going to get done probably at higher numbers than they should. And that's where, from my perspective, I'm not in any rush to get into deals, and don't mind, you know, this whole year being a pause year on investing. I don't have the pressure of needing to invest passively or syndicate, and it's an extreme luxury. But I've been full-time real estate for, and I because it was one of your questions, I looked at the date, since June 17th of 2017. So today is actually my 3-year anniversary of being a full-time real estate investor.
Congratulations.
Yeah.
Great.
And if I'd rather wait and invest in something I'm comfortable in that has you know, adjusted underwriting, because I think most of us are in the same group. The underwriting has changed. Income is flatter. Expenses, you know, you want to make sure that they're being adjusted appropriately for taxes, and that growth is not overly aggressive in a new reality.
Yes, Natalie, I think a few minutes before you told about your horror experience with that GP, right? So I'm sure like you've learned some lessons from them. So I mean, so after that, like, how do you vet the GPs? I mean, so not only if you're co-sponsoring, but even if you're passively investing it, I mean, the passive investor are also in jeopardy, right? If they're going with that kind of GPs or the co-sponsor. So I mean, say, how do you vet your GPs? I mean, sometimes it's intimidating with the GPs if you're asking some personal questions, right? So for example, like with the Sunrock group, we know each other. I mean, so we see each other, but about our personal life, we don't know, right? Unless until you do the deal. So how do you walk that fine line so that you are vetting your future partners, co-sponsors, or the GPs, as well as not upsetting them or you know, kind of going into their personal space. So.
Well, syndicating, if you're looking at co-sponsored, that's a relationship management business, period, like full stop. I can't. I'm Dutch, so I probably am, or European, so I'm probably a little more blunt than some people. And you ask the hard questions. You ask net worth, liquidity, and if you want to know their personal life, you could run credit reports on them. I've done that. Especially if you're co-sponsoring, because you're relying on their good credit, and it's not good credit, you know, in terms of what they tell you. It's good credit on, you know, on paper, legitimately with the bureaus, the different bureaus. So now. everybody's different. I think if you're in the space long enough, you don't get offended by questions. So you should be able to handle essentially any question in general, and then it's up to the individuals whether or not they're comfortable responding to it all or what they choose to share or not. But I think material things, like if there's a past bankruptcy, or if somebody's syndicating but not actually signing on the debt because they're from another country or have things that prohibit them from being essentially the one that's guaranteeing or signing on the loans, things like that. You figure it out in conversation, but it's generally more than one conversation. And I guess what I'm trying to say is don't be afraid of asking the hard questions. They're hard, but you build up a comfort level with them. I tell a lot of people my happy space is not around people, and it's around a computer, spreadsheet, numbers. It's not interacting with people, but you realize that this business is about talking and reaching out to people, and you take the time to do that, and you learn how to do that and improve on that over time. And work, it takes work. Yeah. Right. So maybe it's less real estate investment books, but then it's more of a relationship management type of. The soft skills part is I think for me that was the biggest area of improvement that I needed to do getting into the space was by far. It was the soft skills, interpersonal interaction.
Same for us.
Same here.
Yeah, and I think for a lot of the folks that are attracted to multifamily, engineers, IT folks, which we're in good company. Mm-hmm. It is a real challenge.
Right.
Nathalie, we are running out of time. So the last question, I know you already said you would invest again with a sponsor that has something bad going on, but is able to communicate and explain around that. Do you have any specific characteristics of a sponsor that you other than that one that you said, okay, with this person, I would invest again?
No, I mean, I have it. The thing is sometimes, because I've invested with several first-time syndicators and with good reason, and have been successful with that. But a lot of times when they get to their second or third deal, they might completely change their underwriting or something like that. And then I'm like, great, you had a great first deal, now you're launched, but now you're not, underwriting, or you're co-sponsoring with other people that I'm not comfortable with. Sorry, I'm trailing off. But an example of one that that I have invested with a second time, really there's only one or two, had to do with, it came down to transparency and communication, and then the second part is the financial results. Mm-hmm. You want to feel treated like an owner, because that is essentially what you are. There was an earlier question, and I did want to mention it. The worst thing that can happen to you on a deal, and I've been in a deal that also flooded with Harvey, and that was an unexpected surprise. But I would say the worst thing that can happen to a deal is bad management. And not in the sense of the property management company, but in the sense of the person in the office, the staff in the office. I think most passive syndicate, everybody underestimates how important the folks that are in that office are, and that they drive the financials of the property. So the question is, who's the driver? Who's driving that bus, and how qualified are they? Are they the right fit for the property? Because they can drive it into the ground just as much as they can do amazing things with it as well. That person makes a difference, and I've seen both sides of that coin, horror stories, and then complete reversals.
That's a very important thing. Yeah.
All right, perfect. So with that, I just want to remind everybody with our next meetups. So we're always here the first and the third Wednesday of the month. And if you're not signed up yet, this is our website, is multifamily021.com. If you got this through an email from somebody or on Facebook, then we'll meet again July 1st. And that one, we focus on how to become a better syndicator. And then again, we'll be back on the third Wednesday and how to become a better passive investor. So I want to share Nathalie's email here. Hopefully you're okay, Nathalie, with people contacting you if they have any further questions, looking for a good sponsor, or if they have some future passive investor questions for you.
Yeah. Oh, I applaud anybody that's getting ready to type my last name into into the email.
Thank you very much, Nathalie. It was very, very educating for everyone, including us. We enjoy talking to you every time we learn something new, and hopefully we can get you back in the meetup for the sponsorship side of things. We know you have also a lot of experience on that side that we can benefit from.
Yeah, I guess it was a little bit of a hybrid. I hope folks that were on here got a chance to ask questions, or that everybody got something out of it. I didn't feel like there were that many questions, but maybe.
No.
No, it was perfect. We appreciate it.
No, that was, very, very good session. Thank you, Nathalie.
Thank you for watching this week's episode of the Multifamily 0 to 1 Meetup. Join us live the first and third Wednesday of every month.